Hello from Trend Signal for a review of the data and events of the week beginning the 22nd of January. Over the weekend, the impasse in Congress between the Republicans and Democrats seems to have caught all the headlines, really. U.S. government shutdown sets cautious tone to trades, headline in the FT. This is something that has happened before, and it's interesting just to see how it's developed in something that you think would have been under the control of the Republicans, but certainly not so as the case turns out to be. But you'd be mistaken for thinking there was any problem looking at the way the markets performed last week. The Dow was up 260 odd points, that's about 1%. The S&P up about 25 points, which is about 0.85%. So you wouldn't know there was any issues going on at the moment. The problem is that the Congress needs to pass a short-term funding measure. This comes at a time when Trump is celebrating his first anniversary as president, which is extraordinary. President Trump for a whole year. Something the Democrats in Washington seem to be quite keen to spoil by frustrating this bill over issues to do with illegal immigration or the children of illegal immigrants. So Friday evening, the Senate failed to pass a short-term funding bill as not just a number of Democrats, but also a number of Republicans failed to back the bill, meaning that the vote could not take place. This is the first government shutdown since 2013. But what's sort of unusual about this is that the Republicans hold majorities in both houses in Congress, and it just goes to show you how Trump divides even in his own party. So the effects on the markets, well, equities are so strong, just seem to shrug off any bearish news, really. The last time the government shut down, equities fell, although after 12 days, the increase in government funding was agreed, and stock markets had recovered all that they had lost and more. So the more likely impact, I suspect, could be with the Federal Reserve, where the effects of the shutdown could impact the broader economy if they extend for a lengthy period, which is not necessarily going to happen, of course, but for every week that the government remains in shutdown, the U.S. economy apparently loses $6 billion, which seems an extraordinary amount, but maybe not in comparison to the overall GDP. So perhaps interest rate expectations may soften. The markets had the Fed at 80% odds on for a rate rise in March. If we look at the countdown to the FOMC from the CME, it tells us now that it's at 72.6% for a rate hike from 121.50 to 151.75 basis points. So perhaps if this softens again further, then maybe the dollar might slide again if the opinion shifts down again. Anyway, but the dollar didn't really shift much last week. The euro was largely unchanged. It was just sterling that recovered against the dollar, up over a cent on the week. UK markets, well, they suffered a bit of a setback with some poor retail sales data last Friday, but sterling does seem fairly well bid on the exchanges. Jim O'Neill, a Remain campaigner, was quoted by the BBC in an interview as saying that the Britain should prepare for a much more economically optimistic 2018 because global growth is better than expected. He said the gloomy predictions of the possible effects of Brexit are likely to be dwarfed by the more positive figures. So it's nice to hear a more optimistic take on things, but he did say that the UK would have been doing even better had it decided not to leave the EU. But the overall tone of the interview was quite positive about the UK's prospects, which was encouraging. Let's have a look at the data and events this week. Firstly, the events, a lot of talk in the media about how wealth is concentrated in the hands of the few. The gathering in Davos, Switzerland, which actually is not listed here on Forex Factory, but this is where the mega rich, mega powerful gather to discuss how to fix the world's problems. This so-called World Economic Forum is a 4-day event and begins on Tuesday. Amongst the list of attendees, we have Trump, very much the antithesis of many gathered in Davos, attending, who will be meeting with, amongst others, Theresa May. So maybe they'll look to try and improve relations there. So in addition to Davos this week, we've also got more Q4 earnings. Remember, we had all the bank results last week with some good, some bad. Goldman Sachs posting its first loss since 2011. about 85 firms in the S&P 500 released this week, with names such as General Electric, Ford, Caterpillar, Starbucks, Verizon, and Netflix. I think Netflix released Monday night. Onto the data. Two central banks this week, really nothing Monday. Tuesday, we have the first monthly policy meeting of the year from the Bank of Japan. Decision will happen early Tuesday morning, as you can see. Expect no change in rates, remaining at -0.1, whilst economists expect some sort of an upgrade in 2018 growth outlook for the Japanese economy. But I think with inflation still particularly low, the Bank of Japan is unlikely to signal any tapering of its QE program, certainly at this stage anyway. Thursday is the other meeting, central bank meeting this week, which is from the European Central Bank. No change expected from the ECB. Economists expect the central bank to keep the status quo really until the March meeting at the earliest, unless something happens untoward. Friday, we have the first reading of the gross domestic product for the fourth quarter last year in the UK. That's the value of all goods and services produced in the UK. A bit of a backward-looking indicator telling us what had happened. But it does attract quite a bit of attention. We're expecting a figure of +0.4% from Q3, also +0.4%, which is interesting when you contrast it with the data due from the US. Their GDP for the fourth quarter 2017, they referred to it as they got four readings. The advance is ahead of the prelim, strangely enough, but we're expecting 3%, which is in stark contrast to the UK GDP forecast of +0.4%, albeit down from 3.2% in the third quarter last year, the US. So a slight, you could say it's contracting a little bit. We also have durable goods orders from the US, another useful reading of the health of the US economy and the health of the US consumer. Core durable goods expect to come in at +0.6% after a slight pullback in December. That's it. Thank you very much for listening. All the best. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.